Every stock exchange on Earth sells you the same illusion. The markets move in a smooth line, second by second, shaped by human decisions and rational thought. Prices tick up and down on your screen, green and red like a heartbeat. It feels calm, controlled, understandable. But some of the biggest moves in financial history didn't take seconds. They took milliseconds. Flash crashes are moments when billions of dollars in value seem to evaporate and reappear almost instantly, when the market briefly stops behaving like a marketplace and starts behaving like a glitchy video game. Orders vanish, prices snap to absurd levels, and fortunes are made or wiped out in less time than it takes you to blink. And the disturbing part is this: most people never even see it happen. This is Crash Cabinet, where money, power, and history collide. And nothing is ever as simple as it looks. We're used to thinking of market crashes as slow-motion disasters. 1929 unfolded over days. 1987 took hours. Even the 2008 crisis played out over weeks and months as banks fell one by one. You could watch the fear spread, listen to the news anchors, feel the panic building in real time. Modern markets can experience miniature versions of those events inside a single second. Price charts that look like an elevator cable snapped and then somehow reattached itself. A vertical line down, another vertical line back up. And between those two lines, a brief window where the rules stopped working. To the public, these events are invisible, buried inside high-frequency price data nobody ever looks at. To the people plugged into the system, they are something else entirely. A reminder that our orderly markets are now dominated by machines racing at almost the speed of light, and that the line between normal trading and total chaos is thinner than ever. To understand how a few milliseconds can move billions, you have to go back to a time when markets were slow on purpose. For most of financial history, a crash was a physical event. It happened in a room. Picture the floor of the New York Stock Exchange in the 1970s. Men in colored jackets shouting, waving paper, phones ringing without pause, runners weaving through the crowd with slips of orders. If you wanted to buy or sell, you called your broker. Your broker called their floor trader. The floor trader walked to a specialist. A price was shouted back, written down, confirmed, and only then did your order become part of the market. That chain took minutes. In busy times, it could take much longer. Speed existed, but it lived inside human limits. A sharp trader could react faster than the others, but nobody, no matter how talented or ruthless, could make a billion-dollar decision in a thousandth of a second. All that friction, the phone calls, the paper, the shouting, looked messy, outdated, even primitive. In reality, it was a kind of safety feature. When prices moved, they moved in visible steps. You could see the crowd change. You could feel panic building on the floor. You had a moment, even a short one, to think. Then came a revolution that sounded harmless, even progressive. Computers, electronic trading, and a promise called efficiency. Screens replaced chalkboards. Keyboards replaced hand signals. Runners vanished, and fiber optic cables took over their jobs. At first, it looked like nothing more than a modernization of the same old system. You still had buyers, sellers, and a marketplace. You just moved faster. Hidden inside that change was something much bigger. As you automated away the human bottlenecks, you weren't just making things quicker. You were removing the buffers that stopped markets from behaving like unstable machines. By the 1990s and early 2000s, the idea of fast had been completely rewritten. Phones and floor traders were no longer at the center of the system. Banks and trading firms plugged their computers directly into the exchanges. Software matched orders electronically. You no longer needed a human being to decide what price to bid or ask. You could write code to do it millions of times per second. From there, the logic was simple and ruthless. If speed helped you trade better, and computers were faster than humans, then the winner wouldn't be the investor with the best understanding of companies or the deepest conviction about the future. The winner would be the firm closest to the exchange with the fastest code. That was the birth of high-frequency trading. These firms were not trying to figure out which company would be valuable in 10 years or even 10 months. They were trying to predict what the price of a stock would be a few milliseconds from now. They paid for co-location, moving their servers into the same physical building as the exchange's matching engine. They laid private fiber cables along the straightest possible routes between data centers. They built microwave and millimeter wave networks through the air because radio waves travel differently than light inside glass and can arrive just a little sooner. All of this effort, all of this engineering, just to shave microseconds off the time it took to see a change and react to it. At that speed, trading stops looking like investing in any human sense. It becomes a form of ultra-fast arbitrage, a game of front-running and statistical prediction, where you're not analyzing a business, you're analyzing the behavior of other machines. Most of the time, that system appears stable. Billions of orders zip in and out each day. The vast majority are canceled before they ever trade. To the average investor watching a chart on their phone, it simply looks like a liquid, efficient market. Until, every so often, something breaks. On May 6, 2010, just after 2:30 in the afternoon in New York, The US stock market did something it wasn't supposed to do. The Dow Jones Industrial Average dropped almost 1,000 points in less than 10 minutes. Some of the largest and most stable companies in the world saw their shares plunge to absurd levels. Procter & Gamble briefly lost about a third of its value. Shares of blue-chip companies traded for a penny. Others printed trades at $100,000 a share. Then, just as quickly, the market snapped back. Within 20 minutes, much of the move had reversed. If you only looked at the opening and closing prices that day, it barely registered. To many people, it looked like a data glitch. Inside the system, nobody thought it was a glitch. They had witnessed the first true global flash crash. There was no single villain pulling a plug. There was a chain reaction. A large fund activated an algorithm to sell billions of dollars worth of futures contracts. The algorithm was designed to keep going, regardless of whether the price fell, as long as there was enough volume. It didn't care about value. It cared about getting out. High-frequency firms saw that flow and jumped in, not as stabilizers, but as amplifiers. They bought and sold rapidly, passing contracts back and forth among themselves, generating huge volumes that made the selling algorithm believe the market was deep and could absorb its orders. At some point, many of those high-speed traders made the same decision. At the same moment, something looked wrong. The prices, the patterns, the flows didn't match their expectations. So they did the most rational thing for them. They stepped back. Liquidity, the pool of buyers and sellers that is supposed to make markets work, simply disappeared. In a traditional market, when a big seller appears, buyers step in at lower prices. In an ultra-fast market run by machines, when things look strange, the algorithms can remove their quotes in microseconds. They can retreat to the sidelines and wait. That is exactly what happened. Suddenly there were far more sellers than buyers. There were orders to sell at almost any price, and almost nobody was willing to catch them. Prices didn't just move, they fell through empty air. For those few minutes, the market stopped behaving like a marketplace and started behaving like a malfunctioning machine, throwing out meaningless numbers, testing extremes, trying to find any level where someone would stand in and trade. Then as quickly as they had vanished, buyers reappeared. The algorithms recalibrated. Humans stepped in. The system found a new balance. From the outside, it looked like a bizarre spike. From the inside, it felt like staring into the core of what the market had become. If the flash crash of 2010 showed how the entire market could go insane, the Knight Capital disaster of 2012 showed how a single firm could self-destruct in less than an hour. Knight was a major market maker, one of the firms responsible for providing bids and offers across thousands of stocks. In August 2012, it switched on new software in anticipation of a change in how the exchange handled orders. Inside that code, an old testing function had not been properly disabled. When the new system went live, some of Knight's servers began sending out orders based on that outdated logic. Instead of calmly posting quotes and managing inventory, Knight's algorithm started spraying the market with erratic trades. It bought high and sold low repeatedly, taking the wrong side of its own orders, crossing the spread against itself. All of this happened at machine speed. In about 45 minutes, Knight lost roughly $440 million. Not over a year, not over a quarter. In less time than it takes to sit through a long meeting, a major financial firm essentially destroyed itself because of a software deployment gone wrong. The market survived that day, but the lesson was brutal. When money moves at this speed, a software bug can be as deadly as a bank run. You no longer need fraud, scandal, or months of bad decisions to bring down a company. You just need faulty code and a live connection. And these are only the famous examples. Beneath them, there's a whole shadow history of micro flash crashes and strange spikes. A currency pair that collapses in the middle of the night in Asia and then recovers. An index fund that drops sharply on the open before climbing back within minutes. Individual stocks that trade at nonsensical prices for a second and then normalize. For most people, these events are invisible. They're buried inside the data, averaged out by daily closing prices. But for the people whose orders happen to be sitting in the wrong place at the wrong millisecond, they are very real. Why does the system run this way? The official answer is comforting. Speed, we are told, creates liquidity. More liquidity means tighter spreads, better execution, and lower costs. High-frequency traders, the story goes, are the new market makers, standing ready to buy and sell at all times. There is truth in that. Spreads have narrowed in many markets. Transaction costs, on average, are lower than they were in the 1980s. But that isn't the whole story. Speed is not just a feature, it is a weapon. If you can see the market a fraction of a second before your competitors, you can step in front of their orders, buying just ahead of them and selling to them at a slightly higher price. If your server is physically closer to the exchange's engine, your order wins the race to the book. If your algorithm can predict how other algorithms respond to certain patterns, you can push prices toward those patterns and profit from the reactions. At that point, the market is no longer about long-term value. It becomes about microstructure, latency, and the quirks of how the plumbing works. You are not investing in companies. You're trading the behavior of the system itself. On paper, it all still looks like an incredible achievement. Millions of orders per second. Global connectivity. A retail trader tapping their phone and sending an order straight into the heart of a system once reserved for professionals. It is easy to look at that and say, this is progress. History teaches a different lesson about systems like this. The more tightly you couple them, the more you remove friction and delay, the more you link everything together, the more you depend on everything working perfectly. You remove the human pauses that used to act as shock absorbers. There is no trader picking up a phone and saying, these prices look insane, I'm going to stop for a moment. There is only code reacting to data, even when that data is itself nonsense created by other code. That is how you get feedback loops. That is how you get air pockets in liquidity, where prices free fall because everyone who could catch them has already withdrawn. That is how you wake up one afternoon in a world where trillion-dollar markets can behave like a glitching console. When a flash crash hits, regulators and exchanges often rush to reassure everyone. They bust obviously erroneous trades, canceling the 1-cent executions and the $100,000 outliers. They roll out new safeguards, circuit breakers that halt trading after a certain percentage move, volatility pauses, kill switches. Yet beneath the new rules, the same basic structure remains: a market dominated by machines that can move billions in milliseconds, and a set of participants who can step out of the way instantly whenever things get strange. So who truly bears the risk? High-frequency firms like to present themselves as the good guys of liquidity. They argue that they narrow spreads, reduce costs, and make markets more resilient. But resilience is not measured in normal times. It is measured at the edge, when conditions are ugly. When the edge arrives, those firms can disappear faster than anyone else. They can cancel their orders, flatten their positions, and shut down. Their capital is mobile at the speed of light. Ordinary investors don't have that privilege. Pension funds, retirement accounts, index strategies are all built on the idea of stay the course. They are designed to hold through intraday chaos, to ignore noise, to focus on the long term. That is wise in many ways, but it also means that if something goes wrong in the plumbing, they simply absorb whatever happens in that invisible window. Over years, maybe it averages out. Over years, maybe the system is fair enough. But flash crashes expose an uncomfortable truth. The structure is designed so that a small number of players can profit from the shape of the game itself, while everyone else is encouraged not to look too closely at the glitches. The milliseconds that move billions are not a side story. They are the most honest moment the system gives you, when the mask slips and you see how much of modern finance is trust layered on top of code. So what survives in a world like this? It is not your ability to outclick a machine or to beat a microwave tower in a race. That contest is already lost. What survives is understanding. Knowing that the calm lines on a chart are not guarantees, but averages drawn over countless tiny storms you were never allowed to see. It means recognizing that liquidity is not a promise, it is a mood. It is there until it isn't. It means understanding that when you press buy or sell, your order is not moving through a neutral void. It is entering an arena where machines are fighting over microseconds and where, on rare days, the fight spills over into the prices you see. History's lesson is simple. The systems we build to be efficient eventually reveal their fragilities. Telegraphs gave us panics that spread faster than ever before. Globalization turned local banking failures into international crises. Automation has now turned markets into ultra-fast systems that can fail in ultra-fast ways. From slow-motion panics on a crowded exchange floor to invisible collapses inside data centers, the story has not changed. Only the speed has. So when you hear phrases like orderly markets, modern efficiency, and robust technology, remember the days when billions vanished in milliseconds and then quietly reappeared as if nothing had happened. Remember that for a brief moment, the machine forgot what anything was worth, because nothing about that is normal. It is a reminder that we are all trading inside a system that can, at times, outrun our ability to understand it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.